What's up, guys? It's KYT. Thanks to all of you for getting me across the 300 subscriber threshold. Now let's get to that 1K mark as soon as possible. I was going to do a video on the Terra blockchain and the Luna token because I wanted to add some spice. I think my number one fan, Davies Clark, who's been commenting on all my videos, deserves that spice. He's a fellow degenerate. But on my last video, someone that's about to turn 20 wanted a more comprehensive video on why I think for the average investor, investing in something like XEQT is the best decision. And I haven't made a more full, complete XEQT video with this new camera. So here we go. So the kid that left the comment is about to turn 20, and it made me think about what I wish I would have known when I was 20. And I think when people were telling me to save money, like my mom was telling me it was a good idea, it was good advice. But the problem was because I didn't know at the time when I was young, I didn't put an importance on what things actually cost that I would need later on in life. It didn't really motivate me to save, and it didn't tell me how aggressively I needed to save. Like, for example, now I know that getting a car, if I wanted to buy a car, new one, cost me mid 5 figures. Houses, a really nice house might cost me $600,000 right now, and they're trending to $800,000. And how much for early retirement? I mean, now I know I need $1.5, $2 million at some point to be able to withdraw safely post-retirement. So these are the things that you're gonna have to know. Like, I didn't know how much a wedding cost, and I wish I knew. I had a vague idea. So you're gonna have to do that. I think that's a key step, really educating yourself as to what things you might want later in life cost now, and obviously they're gonna be more expensive due to inflation. Now, one more thing before we jump into XEQT, I wish I knew that these were the 3 key components to building my wealth, which was number 1, increase your income. That could be getting a side hustle, that could be getting promotions at your job, that could be moving from company to company. It could be many things. Number 2, reducing expenses. That could just be getting better at budgeting monthly and things like that. And number 3, invest wisely. These are the 3 key components. They're each important in their own way. And I think with YouTube, we focus too much on number 3 with all these different stock picks and all these money symbols and all of that. But number 1 and number 2, though they might be less sexy on YouTube, they are just as important. Now, I'm going to very briefly explain some basic ideas and principles that the original commenter may not need or ask for, but I do want to cover all my bases. So why do we invest? We invest in the stock market because we expect the global economy to increase over time. Not every year, but over a long period of time, it should go up. And holding cash as long-term savings is a bad idea, obviously, because of inflation. So where do I even start investing, you may ask? Well, I got the best answer for you. It's in one of the links in my description. It's Wealthsimple. It's the best solution for Canadians, in my opinion. So definitely go check it out. So now the question is, why invest in an ETF? Why invest in a diversified set of funds? Why invest in something that invests in over 9,000 companies, let's say, like XEQT? Because it's really hard to stock pick, and we can see countless studies that have been done that show that over a long period of time, it is really hard for an active fund manager to beat the index. We also know that the stock market exhibits some sort of positive skewness in the sense that a small number of stocks drives the overall market return. What does that really mean? In other words, it means most stocks do really bad or mediocre, and a small number of them do really well. And if you miss out, if you fail to identify the small amount of holdings that do really well, you are going to underperform the index, most likely. There are lots of studies, but I'll just put one graphic up so you can visually see this. For example, the S&P 500 over a 20-year span, between 1998 to 2017, you can see the frequency of the stocks and where they appear, what the returns are. So you can see there are a lot of them are clustered around here. They've done poorly. And then there's that small number of stocks that drive the return. Of course, you could stock pick for fun or for that chance at risk of hitting a home run. But if you're doing it seriously for the long run, it has to mean that you think you're better than the average active manager at finding those key overperformers. Now that I've successfully convinced you to get an ETF, it becomes a question of which one and why. Now, some of these ETFs for us Canadians were only recently created. In fact, XEQT was only created in 2019, and some of its competitors like VEQT 2019 as well, and ZEQT from BMO was created earlier this year. Yeah, 2022 in January. Now, all three of them, I recommend it's really a coin flip between the three. They don't really, I'm not gonna say which one of them is better. It really honestly is a coin flip. The main awesomeness, the awesome sauce of these asset allocation ETFs is that they rebalance by themselves without us having to interfere doing any manual work. Basically, when some of the funds, some of the stocks in your ETF do really well, they're going to be sold, and some of the underperformers or ones that aren't doing as well, they're going to be bought, because the concept here is that you never want to be too heavily invested in one particular industry, because if that one goes down for whatever reason, you don't want to be that hurt by it. So even if something's been doing well, you want to sell, diversify to the other stocks in your portfolio. Asset allocation ETFs honestly make it so you have to do the least amount of work. And to look at the differences between them, I often like to show this website by Justin Bender, the Canadian portfolio manager. So here's the different XEQT asset allocation ETFs, and you can do the research yourself. It is known that bonds underperform stocks in the long run, but have a lower volatility, meaning they are safer in the short term. Now, if you have an investment time horizon of 10, 20, 30 plus years like me, you should be leaning more and more towards equities. And at the extremely long time horizon, 100% equities. That is because it's supposed to give you, based on the data that we have, the highest return. The highest return over a long period of time, though, that's key to understand. It's like if you were guessing the flip of a coin, heads or tails, you could be wrong 12 times in a row. Stocks can go down many years in a row. The idea is that after a long period of time, after a long amount of coin flips, you will converge to 50%. And here for stocks, you will converge to something like an 8% annualized return. So you got to stick it for the long run. And that's why I think XEQT, VEQT, and now ZEQT are three of the very best choices a new investor can make. But again, that's for me. If I was starting out, about to turn 20, have this long time horizon to save up and invest a lot of money, and it does it with minimal manual work involved. And I think that's key, because crushing it at your day job, crushing it at your side hustle is more important than tweaking your investment strategy. Trust me. Now, I can't end this video without talking about dividends a little. I've talked about how dividends don't matter to me. XEQT could be giving me 2%, 10% dividends. It doesn't matter. What I do with them is I reinvest in XEQT. And that's why, if you're like me, they shouldn't matter either. Now, I see a lot of young YouTubers, Canadian YouTubers, they have spreadsheets, they have their YouTube thumbnails talking about like how much income they've made, passive income per month. And that's not really important. That might cause you to focus on the wrong thing, which is maybe buying too many stocks that have high dividend yield. The idea is really that at the end of the investment phase, I don't know why I did air quotes, investment phase of your journey, you have the highest amount of money, and then you can decide to do a dividend strategy so that, post-retirement, you get that 4% that you can spend on things. But from here until when I'm 65, or hopefully a lot earlier, like 65 is probably a super conservative estimate, until that point where I decide to retire, then I can choose to be more passive income and stuff like that. But I don't need to do that now. The focus is maximizing my return so I can have that $1 to $2 million portfolio to then get dividends from. So I hope that makes sense. If it doesn't, be sure to leave a comment. I don't want to come across as a hater, but I want the new investor to be careful when consuming content on YouTube, especially with thumbnails that suggest that they should buy a hot new stock. Every month they have to post a new video and talk about, the new February stock, this hot new stock, when really all you need is to buy one ETF for the next 10, 20, 30 years, and you're good. With that said, I'm sorry, Davies. Hopefully you can stick around for one more video. See you in the next one.